It is Tuesday morning, February 3rd, 2026. The smoke is finally clearing after one of the most brutal trading sessions we have seen in years. If you are watching this, congratulations, you survived the Monday massacre. Yesterday at exactly 10 o'clock a.m. Eastern Standard Time, we watched a high-speed collision. The massive 15% liquidation from the Indian physical market crashed straight into the United States. Manufacturing data. It was not pretty. It was a financial crime scene involving billions of dollars in paper contracts. Now I need you to do me a favor. Stop refreshing your brokerage app. Tell your boss you are in a very important strategy meeting, and pay attention, because we need to figure out if that was the bottom or if we are just falling past the first floor. Before we dissect the damage, I need to know where you are surviving this from. Are you sipping expensive coffee in the glass towers of Canary Wharf? Hiding in a bathroom break on Wall Street? Or are you hunting for physical bargains on the streets of Mumbai? Let me know your coordinates in the comments. Let us peel back the skin of this market and look at the muscle and bone underneath. To the untrained eye, what happened yesterday looked like chaos. To a forensic analyst, it looked like a calculated demolition. We need to understand the mechanics of why the floor fell out from under the price, because this was not a random event. It was a perfect storm of three specific structural failures converging at the exact same moment. You have heard the headlines, but let me explain the mechanics of that crash. When the markets in Mumbai opened, we saw a cascade of profit-taking that wiped out nearly 45,000 rupees per kilogram in a single session. This is not just a local event. India is a primary lung of the physical silver market. When India stops breathing, the global market starts to suffocate. The mechanism here is critical. The Indian dealers were front-running the union budget announcements, fearing a change in import duties, so they dumped inventory. This created a massive arbitrage gap between the physical price in the East and the paper price in the West. Usually, arbitrage bots would step in to close this gap, buying in Mumbai and selling in New York, but yesterday, that bridge collapsed. The spread was too wide, and the volatility was too high. The machine simply turned off. When the liquidity providers step away, the price does not just slide, it teleports downward. Then we have the second factor, the Kevin Warsh effect. The nomination of Kevin Warsh as the next chair of the Federal Reserve is not just a personnel change, it is a regime change. The market algorithms are programmed to read Warsh as a hawk, a strong dollar advocate, someone who is willing to inflict pain to stabilize the currency. Yesterday morning, before the New York coffee was even brewed, the currency algorithms were already pricing in a stronger dollar index. You saw the dollar spike in the binary code of the trading bots. A stronger dollar equals a weaker silver price. It is a simple, brutal equation. The moment the Newswire confirmed the Warsh nomination sentiment, the high-frequency trading desks initiated a massive short program. They were not selling because they hate silver. They were selling because their code told them the dollar was king again.
And finally, we arrive at the murder weapon itself, the ISM manufacturing data at 10 a.m. This was the trigger pull. The market was already bleeding from the Indian news and the Warsh announcement. It was fragile. It was standing on a ledge. Then the data dropped. Whether the number was 49 or 51 is almost irrelevant at this point. The reaction was the key. The volatility spike that followed the release acted like a depth charge. It hunted down the stop-loss orders of every retail trader who was long. We call this a long squeeze cascade. Imagine a row of dominoes. The first domino was the trader with a stop-loss at $84. When that triggered, it became a market sell order, which pushed the price down to $83.80. That triggered the next batch of stops, then the next. Within milliseconds, millions of ounces of paper silver were dumped onto a market that had no buyers. This is why you saw the price freefall vertically. It was a chain reaction of forced liquidations. But here is the detail that the mainstream news will miss. While retail traders were puking their positions, who was on the other side of the trade? Who was buying? If you look at the volume profile from yesterday, you will see something strange. Massive limit buy orders were sitting deep in the order book waiting to catch the falling knives. This bears the signature of the bullion banks, the commercial entities like JP Morgan and HSBC. For months, these institutions have been holding massive short positions. They have been underwater. Yesterday gave them the perfect exit door. They used your panic to cover their shorts. They effectively swapped their paper debts for your physical assets at a discount. They shifted their books from net short to neutral, or perhaps even net long, all while the average investor was selling at the absolute bottom. This brings us to the leverage ratio. We are operating in a market with a leverage ratio of roughly 356 to 1. That means for every 356 ounces of paper silver traded, there is only 1 ounce of physical registered silver in the vault backing it. When volatility hits, that leverage works like a guillotine. Yesterday, the margin clerks were the busiest people on Wall Street. As prices dropped, margin calls went out. Traders had to choose: deposit more cash or sell the position. Most could not deposit cash fast enough, so the broker sold for them. This forced selling creates a feedback loop that has nothing to do with supply and demand and everything to do with solvency. So when you look at that red candle on the chart, do not see it as a loss of value. See it as a transfer of ownership. Weak hands were washed out, leveraged players were destroyed, and the entities with the deepest pockets and the longest time horizons were waiting at the bottom with their baskets open. We witnessed a structural reset. The paper market burned down so the physical market could be accumulated. The question you need to ask yourself is not why the price went down. It is who is holding the metal now that the dust is settled. To understand where we are going, we must look at the ghosts of the past. History is a crime scene that tends to repeat itself, and yesterday's crash has happened before. We are standing at a crossroads between two very specific historical precedents. We need to determine if we are reliving the nightmare of May 2011 or the golden opportunity of March 2020.
We need to talk about the physical reality of the metal itself, because this is where the paper market narrative completely falls apart. If you looked at your screen yesterday during the crash, you saw a number. Maybe you saw $78. Maybe you saw $80. The computer screen told you that the value of silver had plummeted. It told you that silver was on sale. It told you that nobody wanted it. But did you try to buy it? I want you to try a simple experiment today. Pick up the phone, call your local bullion dealer, or go to one of the major online retailers. Try to buy a 1-ounce American Silver Eagle for the spot price you see on the television. They will laugh at you. Yesterday, while the paper price was collapsing by double digits, the physical price, the price you actually pay to hold the metal in your hand, did not move in a straight line down. In fact, in many places the premiums exploded. This is what we call decoupling. It is the moment when the map no longer matches the territory. When the price crashed, the physical market did not panic sell, it panic bought. The phones at the bullion dealers were ringing off the hook. Why? Because the industrial users and the smart money know something that the algorithm traders do not. They know that you cannot print silver. Let us look at the demand side of the equation for the year 2026. We are not talking about spoons and forks anymore. We are talking about the absolute necessities of modern civilization. Silver is the single most conductive metal on the periodic table. It is the best reflector of visible light. It is thermally conductive. It is antibacterial. It is the blood in the veins of the digital economy. The solar industry is currently devouring silver at a rate that was considered impossible 5 years ago. We have moved beyond the old solar technology. The new standard tunnel oxide passivated contact cells, or POPCon cells, requires significantly more silver paste per unit than the old panels. China is carpeting its deserts with solar farms. Europe is mandating solar on rooftops. Every single one of those panels represents silver that is taken out of the ground and locked away on a roof for 20 years. It is gone from the market. It is not coming back as scrap anytime soon. Yesterday's paper crash did not change the physics of a solar panel. It did not make electricity conduct through copper as efficiently as it conducts through silver. For the last 2 years, the Shanghai Gold Exchange has been trading at a significant premium over London and New York. This is called the Shanghai Premium. It acts like a giant vacuum cleaner. It sucks physical bars out of the Western vaults, out of London, out of Switzerland, and moves them permanently into Asian vaults. Why does this matter? Because the West trades ghost silver. In New York and London, we trade promissory notes. We trade unallocated accounts. We trade leverage. We bet on the price of a thing without ever touching the thing. The East trades the metal itself. China and the BRICS nations are not accumulating silver to flip it for a profit next week. They are accumulating it for strategic dominance. They know that silver is the conductive vein of the modern economy. You cannot build a solar panel without it. You cannot build a cruise missile without it. You cannot build the 5G infrastructure or the AI data centers without it. While the Western hedge funds are panicked about Kevin Warsh and the Federal Reserve interest rates, the Eastern planners are looking at the supply chain of the next 10 years. They see a shortage. a mathematical impossibility of supply meeting demand. So when the price crashes on the COMEX in New York, the East does not panic. They celebrate. They see it as a discount on strategic resources. Yesterday's crash was a gift to the People's Bank of China. It was a gift to the Reserve Bank of India. It allowed them to acquire more tons of metal for fewer worthless fiat dollars. This is the geopolitical divergence. The West is obsessed with the price. The East is obsessed with the ounces. If you look at the flow of metal, it is a one-way street. The inventories in the COMEX registered vaults and the London Bullion Market Association are draining. They have been draining for months. The metal is leaving the casino and going into private storage. This creates a coiled spring. The paper market can suppress the price for a while. They can print infinite contracts. They can sell 1 billion ounces of paper silver in a second. But they cannot print a single ounce of physical silver. Eventually, the paper market has to settle in physical metal. And when the holders of those paper contracts stand for delivery and the vault is empty because the metal is in Shanghai, that is when the price discovery mechanism breaks. We are seeing the early tremors of that break. The volatility you saw yesterday, that violent 15% swing, that is not a sign of a healthy market. That is a sign of a market that is running out of physical buffer. It is snapping back and forth because the liquidity is drying up. Then we have the artificial intelligence boom and the military-industrial complex. We are building data centers at a rate that is straining the global power grid. These AI processors require high-performance connectors. You cannot use a cheap substitute in a server that costs $100,000. You use silver. And the wars of the 21st century are fought with guided missiles, drones, and satellites. A Tomahawk cruise missile contains roughly 15 kilograms of silver. When that missile is fired, that silver doesn't go back into the vault. It explodes. It is vaporized. It is consumed forever. Now look at the supply side. This is the other half of the scissors. While demand is vertical, supply is horizontal or falling. We have not found a major new primary silver mine in over a decade. The ore grades are collapsing. We are digging deeper and processing more earth just to get the same amount of metal. Most silver is a byproduct. Even if the price of silver went to $500 tomorrow, the copper mines could not simply flip a switch and produce more silver. So here is the setup that the paper traders ignored yesterday. We have a market where demand is driven by price-insensitive buyers. Government mandates, energy transition, war, and a supply chain that is stretched to the breaking point. Yesterday's crash was a paper illusion. So where do we go from here? The crash of Monday, February 2nd, is now in the history books. We are entering the repair phase. For the next 48 hours, I am watching 3 specific scenarios. You need to memorize these because one of them is playing out right now on your screen. Scenario Alpha, the dead cat bounce. In this scenario, we see a weak rally today. The price drifts up to maybe $88 or $90. It looks promising. The retail traders who missed the bottom start chasing the green candles, thinking the worst is over. But the volume is low. This is a trap. The institutions are not buying. They are just stepping back to let the price float up so they can short it again. If you see the price rising on low volume, do not bite. It is bait. Scenario Beta. The V-shaped squeeze. This is the violent reversal. If the physical buyers in Asia continue to drain the vaults, and if the premiums on American Eagles start to widen even further, we could see a short squeeze. The banks who covered yesterday might flip long. If we break above $92 with high volume, the bears who sold yesterday will be trapped. They will have to buy back their positions at a loss, fueling a vertical rally that could take us back to $100 by Friday. This is the low probability, high impact outcome. Then we have the artificial intelligence boom and the military-industrial complex. We are building data centers at a rate that is straining the global power grid. These AI processors require high-performance connectors. You cannot use a cheap substitute in a server that costs $100,000. You use silver. And the wars of the 21st century are fought with guided missiles, drones, and satellites. A Tomahawk cruise missile contains roughly 15 kilograms of silver. When that missile is fired, that silver doesn't go back into the vault. It explodes. It is vaporized. It is consumed forever. Now look at the supply side. This is the other half of the scissors. While demand is vertical, supply is horizontal or falling. We have not found a major new primary silver mine in over a decade. The ore grades are collapsing. We are digging deeper and processing more earth just to get the same amount of metal. Most silver is a byproduct. Even if the price of silver went to $500 tomorrow, The copper mines could not simply flip a switch and produce more silver. So here is the setup that the paper traders ignored yesterday. We have a market where demand is driven by price-insensitive buyers. Government mandates, energy transition, war, and a supply chain that is stretched to the breaking point. Yesterday's crash was a paper illusion. So where do we go from here? The crash of Monday, February 2nd, is now in the history books. We are entering the repair phase. For the next 48 hours, I am watching 3 specific scenarios. You need to memorize these because one of them is playing out right now on your screen. Scenario Alpha, the dead cat bounce. In this scenario, we see a weak rally today. The price drifts up to maybe $88 or $90. It looks promising. The retail traders who missed the bottom start chasing the green candles, thinking the worst is over. But the volume is low. This is a trap. The institutions are not buying. They are just stepping back to let the price float up so they can short it again. If you see the price rising on low volume, do not bite. It is bait. Scenario Beta. The V-shaped squeeze. This is the violent reversal. If the physical buyers in Asia continue to drain the vaults, and if the premiums on American Eagles start to widen even further, we could see a short squeeze. The banks who covered yesterday might flip long. If we break above $92 with high volume, the bears who sold yesterday will be trapped. They will have to buy back their positions at a loss, fueling a vertical rally that could take us back to $100 by Friday. This is the low probability, high impact outcome. This is the most likely and the most painful scenario. The market chops sideways between $80 and $90. It becomes boring. It grinds back and forth, killing both the bulls and the bears who are using leverage. This is designed to make you lose interest. It is designed to make you walk away. My advice to you is simple. Do not try to be a hero today. If you're holding physical metal, your strategy is the easiest. Do nothing. You do not own paper promises. You own the asset. The weight of the coin in your hand did not change yesterday. 1 ounce is still 1 ounce. If you are a trader using leverage, cut your position size in half. Then cut it in half again. The volatility is not over. We still have the Friday jobs report coming up. And if you are sitting on cash looking to enter, watch the premiums. Do not look at the spot price. Call your dealer. If the premium starts to drop, it means the physical market is relaxing. That is your signal that the bottom might be real. If the premium stays high, be careful. The stress is still in the system. Do not let the volatility shake you out of a generational asset. The paper price is a distraction. The transfer of wealth is the reality. Stay skeptical, stay disciplined, and most importantly, stay safe.